Morning, everyone. This is Ben Ryan, and welcome to the Hedgeye morning macro call for Wednesday, November 26, 2014. Before I hand the call over to Keith, I'll briefly hit on our asset allocation mix, which is unchanged from yesterday, sitting at 64% cash, 31% fixed income, 5% foreign currency, and no allocation, so that's 0% to commodities, international equities, and U.S. equities. That take away, Keith.
Thanks, Ben. And those asset allocations, again, are net. So again, net exposure 0%. So again, if you take your longs minus your shorts, it's net zero. If you have a net long position that is leaning, which we have in fixed income and in cash, you can like it because you're making money on that. So again, that's our setup, and we're sticking to it. So today's top three things in my notebook: number one, the price of oil; number two, the 10-year bond yield; and number three, U.S. equity market sentiment, which is becoming epic at this point. So again, looking at oil, which is leading indicator number one for what? For deflation. Now again, oil, people have been looking for the bounce. There's a massive net long position in CFTC futures and options contracts, still over 276,000 net longs on that front. And again, people are looking for the bounce. They've been looking for the bounce. They don't understand the complex of deflation. Again, deflation is a very nasty signal. It's bad for energy stocks. It's bad for energy bonds. And yes, we think the oil price goes lower. Intermediate term support, no support really to $64 WTI and falling from there. Now, point number two would be the 10-year bond yield. Now, something not so funny happened on the way to the forum to those poor bastards who are along the TBT, yeah, you, yeah, and me, on a better than expected quote-unquote GDP number yesterday. Newsflash, it wasn't better than expected if you look at it the way that we model it, which has not changed for 6 years, which is on a year-over-year basis. Now, again, going totally revolutionary on you. Yeah, again, modeling things on a year-over-year basis isn't that complicated, other than for those who are just navel gazing at headlines that are hitting your screen currently on any macro data point front. So again, rate of change, GDP growth slowed in the third quarter. It slowed in the first quarter, the second quarter, and it will slow again in the fourth quarter. What happens when growth slows in rate of change terms? Put a big smile on your face. Bond yields fall. The TLT goes up. The EDV goes up, so we reiterate the bull case and a massive asset allocation position, net long position, almost fully loaded in our model to the long bond, and liking that. Finally, equity market sentiment. Now, this is becoming epic beyond epic. Now again, what we'd like to look at, and again, I'll give you two different things. Front month volatility from an equity market perspective, looking at the VIX. Immediate term support is 1216. So we're at the low end of that sentiment reading. We're at the highest end on what we call the bull-bear spread. So again, bull-bear spread comes out every Wednesday. Again, it's an II survey that surveys, are you bullish or are you bearish on my flow? Again, are you bullish? Yes, of course people are bullish. Are you bearish? There are no bears left. In the survey currently, 13.8% of people admitted that they were bearish. That is the all-time low in bears. All-time low. The spread between bulls and bears is 4,270 basis points wide. That's up 108% since when the bulls were in the fetal position on October the 13th. Is sentiment peaking? I just told you so. Those are your top three things. So today is the morning show ahead of the Thanksgiving weekend. So again, looking at for what it is, we're not going to change the process. Looking at risk ranges, trend levels, and God forbid, fundamental views from Hedgeye Risk Management, which are indeed proprietary, I might add. Looking at the risk range in the S&P 500, immediate term trade support is 2020. Immediate term trade resistance is 27.4. So again, if you're in the mood to short the SPYs on your Thanksgiving, wait for 2074. If you are going to cover the SPYs, wait for 2020. Again, 2020 being the level, not the year. And some people do think that they may have to wait to 2020 to ever short the SPYs again. So again, looking at it for what we do, we sell high, we cover low, and again, that's the process. Do not change the process. It's the best way to front run the moving monkeys or the momentum chasers. We have nothing against them. They call us ugly hockey players. I mean, we can call each other little names. It's just fun in the game. Again, if you don't love the game and you don't call people names, you certainly don't play it the way that I do. Looking at the Russell 2000, immediate term downside in the risk range to 1154. 1190 is resistance. That's the trend line. So again, Russell 2000's trend is bearish. It's teetering towards the top end of its immediate term risk range, which is also bearish. So sell yourself some Russell 2000s in Russell 2000 terms, as you've been doing since July 7th and making money at the top end of the risk range. Looking at the risk range for volatility, again, the VIX immediate term trade over sold line is 1216. Immediate term trade over bought line is 15.62. So again, 1216 to 1562. That's your risk range and volatility. The upside down of that is the S&P 500. They are inversely correlated. So again, when the VIX gets to the low end of the range and the S&P gets to the high end of the range, you know exactly what to do. Advanced decline line yesterday, just news flash, was pretty much embarrassing. So again, as we were hitting the all-time highs in the S&P 500, which is everyone's navel-gazing thing to watch, if in fact they have gone beyond the Dow at this point, they would notice that a lot of things within the S&P 500, it's called breadth, are deteriorating. So again, it's not my breath, it is the breadth with a DTH. And again, that is what's going on at the sector level. Yesterday, energy stocks got plowed again to the downside. XLE, which is the XLE is the sector ETF for the S&P 500, down 2.5% in the last 2 days, and I submit that it's most likely not going to have a good day again today. So again, being long something like healthcare, which is our favorite sector, XLV, versus short the energy, which is XLE or XOP. I'm giving you a little ETF pin action there. Again, that's what you do, and you'd like it. It's called longs versus shorts. So you can have a net exposure of 0 to the U.S. equity market bubble, and you can be long healthcare, and you can be short energy, and you can have a gigantic smile on your face. Your wife's going to love it. Your husband's going to love it because you have positive P&L as a result of it. Cool. Looking at volume yesterday, again, volume on the down move accelerated. On the down move, accelerated. We've been talking about volume accelerating only on market down moves. So again, accelerating again on the down move, up 1%, albeit versus the 1 month average. But again, what you saw on the up moves was decelerating volume. So again, rate of change, really basic concept. Not a lot of people use it the way that we do. But again, it's a very basic concept in all natural things that are life. And again, we suggest you pay attention to them. Now, looking at Asia, which is another part of the earth that has life. But again, from an equity market perspective, the only things that have really had life are those that have the latest central plans. Now, again, to remind you, the Nikkei would not be going up if the Japanese didn't introduce their panic Control P central plan. Neither would Chinese stocks. And again, the reason why the Japanese and really the Chinese are panicking are what? Because growth is slowing. It is surprising them to the downside. So unless your bull case was that China and Japan would slow and that they would panic, you really have no business telling me that you've nailed it. You may have nailed it for the wrong reasons, but that exactly doesn't give me a process that I can invest in. But again, understand it for what it is. Away from that, you've seen Asia really weak. I mean, the Kospi did nothing again overnight. Thailand was down 0.4%. Vietnam, I know everybody's talking about Vietnam this morning, is down 1.6%. So again, you look at it for what it is. There are some interesting buying opportunities in Asian equities. We have liked India throughout the year. We do not like it at this price. Again, at a price, we will like India and Indonesia, then maybe Thailand. In that order, but we will not be chasing the Nikkei up here. The Weimar Nikkei, that being, was down last night. Just a super secret thing there. The Weimar Nikkei was down 0.14% last night. So again, losing a little bit of its squeeze action there. Europe across the board, look at this. Europe, go, yeah, whoa, you hit an overbought level and you went down. And then you got these moving monkeys on Twitter saying, my target, they got these big round targets. They're like, look at the DAX, look at the big round target. I nailed the target. How about we go away from the DAX and we go short Russia or we go short Greece? These markets are down 1.5%, 2.5% again this morning. These have been fantastic shorts in the face of European rallies. So when you're bearish on an economic framework like Europe is right now, you don't have to short the DAX. You haven't seen us do that, obviously. What you do is you go down the line and you take shots at the ones that have the weakest fundamentals. In order, Russia, France, Greece, bang, bang, bang. That's what you do. You pop, pop, bang. That's what you do. Again, you short things when they bounce within a bearish trend. This is a really simple concept. Again, don't navel gaze at the Dow and the DAX or you will get run over in macro interconnected terms. Looking at the rest of the world from a commodity perspective, deflation continues to be pervasive. You can see that in the CRB index, which is being amplified this morning by the copper. The Dr. Copper, which the former permabulls that used to say Dr. Kospi and Dr. Copper when they're going up are a global growth signal. Now the Dr. Kospi and the Dr. Copper are going down. But that's not a bearish growth signal. Got it? Okay, Roger on that. I mean, the reality is that it is. So again, Dr. Copper's breaking down. Inflation expectations are breaking down. It's called deflation. So again, if you're short copper, congratulations. Looking at 10-year bond yield on risk range, again, no immediate term trade support for the 10-year bond yield to 2.22%. We've been making this call throughout the year. I'm not going to reiterate that. Again, other than it is down 26% for the year to date, i.e. bond yields continue to crash. And again, that's why you continue to get paid on the long side of the long bond. Now, economic data points, interesting and maybe not surprising. Jobless claims rising above 300,000. So again, we've shown this chart many, many times. If you have any perspective, you will pull the data back to the 1980s, and you will see that jobless claims, from a long-term perspective, maybe we can get this chart up in front of you, but I'm sure for those of you who follow us closely, you could see it. The range of jobless claims, again, think standard deviations of risk. The range on the high end is over 600,000, and on the low end is below 300,000. So in other words, when you get over 600,000 jobless claims, 2009, you buy everything equities. The Starbucks, you could buy it at $11. $11. Again, over 600,000. When you're below 300,000, you start to sell everything you bought when jobless claims are above 600,000. Now that is a cyclical investor. That's what I like. That is a genius. That is not what you see on Twitter currently. That is not what you see on Wall Street. People don't really buy low and sell high, but if you use jobless claims, which is a lagging indicator that is also pro-cyclical, when it gets below 300,000 on jobless claims, the next move is higher, not lower. And again, our call on the Fed is that as jobless claims rise, the Fed will get more dovish and bond yields will go lower. Again, hopefully I explained that about as simply as I can this morning, Ben Ryan, because again, it's easier to understand than the consumer confidence reading just getting smoked yesterday, month over month, and Bloomberg running a headline saying that the S&P 500 is at all-time highs on consumer confidence. I couldn't figure that out. We pay Bloomberg a lot of money too. I mean, what is up with that? Is Joey controlling the headlines at the Bloomberg? I mean, we got a lot of weird stuff going on from Ferguson to Uber and back again, so maybe a good spot to take some questions.
All right. Getting me fired up too here. All right, we'll try to.
It's hot in here. It's hot.
It is.
We're both wearing sweaters.
All right, so we'll try to fire off a lot of questions. I want to buy something. Where are you buying today? What are you buying?
Oh, geez. I mean, I can't buy bonds today because they've already had their move for the week. I can't go buy myself any more Hedgeye stock because I already got too much of that. I'm not buying Uber at $40 billion in market cap. You know, today we'll see. Again, there will be some interesting signals. One thing I'm actually watching is IDX, which is Indonesia. Again, if the dollar were to get a little weaker here on jobless claims, what you're going to start to see is some emerging market stabilization. So there are some markets, like I said, India, which from an ETF perspective is INP, and then IDX. I'm just watching those, you know, not pulling the trigger just here and now yet.
All right, next one, question on the risk ranges. And you actually, I remember you explained this, must have been last Friday. We look at the risk ranges and just consider them stops?
Exactly. So again, risk range, Ben's question is, can you look at them as stops? So in other words, if I'm looking at a range of risk, the S&P 500's range of risk currently on an immediate term trade basis, and this changes every 90 minutes of trading. I reload the model. Again, it's dynamic, so again, it changes throughout the day with volume, volatility, and price changes. At 2020, that's your stop on the downside, and 2074 is your stop on the upside. So again, that's a good way to think about it. Not all the time are you going to get paid there, but the idea in macro is that you want to get paid more than you don't get paid. So again, if you can be right 55 to 65% of the time in macro, you're going to probably be pretty good. If you can be right 75% of the time, making good decisions within the risk range, you're going to be damn good.
Next question here. Is there anyone set up for a surprisingly weak December market, and how do you know? What are you looking at?
No, of course not. You know, people do not, we are in an asset management bubble. Again, we have 14,000 hedge funds, $3 trillion in assets under management, most of them not really making a lot of money, most being called 70 to 80% of them. We have a bubble in RIAs. We have $3 trillion under management in purely RIA money. We have money managers all over the planet that can't beat beta. So what happens is that they chase performance. And when you see people chase, and again, we gave you the look through on sentiment rewind this at the top of this show, again, from a sentiment perspective, from a bull-bear spread perspective, from a top end of the risk range perspective, from a global growth and inflation signaling perspective, we're absolutely at the point, which would be fascinating. Again, if you were to fast forward maybe 6 months, 9 months from now, and today was the all-time high in the S&P 500, people would have no business explaining why they missed it. This is not the kind of place where a bunch of people could say, well, nobody could have seen this coming. I mean, the only thing you can't see coming is an oncoming train if you're standing right in front of it at this point. So again, that's where I do think that December could easily, pancake people, just like October did. Don't forget, it was like, boom, flat on your back. People are like, oh, what am I going to do about that? I mean, I think that's coming. I think it's going to come fast.
All right, next question on the dollar here. If the U.S. dollar begins to roll over, will you use that information as a possible clue that the Fed is getting ready for more easing in the future? And will gold then become a commodity worth buying?
Yes, I think, again, what I'd like to see with gold is the dollar stop going up first, because what the gold price really likes is interest rates and the dollar falling at the same time. So again, back to the question, if your leading indicator is the Fed getting more dovish on the margin due to either labor market starting to deteriorate, which again is the point I was making on jobless claims, and or deflation, which is pretty obvious from a break-evens, tips, crude oil perspective this morning. The Fed getting easier, if that were to get the dollar to go down relative to the other guys burning their currencies, which are the Japanese and the Europeans, absolutely yes. But again, we're waiting and watching on that.
Okay. When do you think Russia will, this is kind of this will probably warrant a longer answer, but when do you think Russia will turn around and become a cheap buy here?
Russia has been cheap for as long as I've been in this business. Cheap gets cheaper when oil prices are falling too. That's the point. Russia will trade in a band of the lowest multiple you can possibly imagine, like 2 to 3 times earnings, and something like inside of 10. But when the leading indicator, both their growth and currencies are falling, in this case in Russia's crashing, you don't buy valuation. Valuation's based on an earnings estimate. An earnings estimate is based on some cockamamie expectation of growth. If they are going to have neither, your valuation argument is cockamamie too, because you're basing your multiple on something that doesn't matter. So again, that's the point. Cyclicals and highly suspect macro positions that look like this, i.e. crashing, are not buy signals until the rate of change delta goes positive, which we're currently not seeing in either Russian growth, the Russian currency, and or the oil price.
All right, question here on tactical asset rotation. What would cause you to get bearish on XLY and IBB? It's consumer discretionary for those, and then biotech.
Yeah, I don't know, like biotech, obviously we like healthcare, and biotech's the juiciest part of healthcare, so we've stayed away, thank God, for a while here being short biotech. Why would you short something that's the juiciest part of the sector that you like? Now, the sector that we like, healthcare, XLV is up 24% for the year to date. So if you're long that, congratulations too. But again, the thing about biotech that I think I've said this before, what is there not to like about companies that don't have revenues or earnings? I mean, then it's just purely a story. And that's the epicenter of bubbles. What is a bubble? It's something that goes up and the story's good without anything to refute that. Now, if you had revenues and earnings, those could refute that. So biotech obviously looks pretty good. Consumer discretionary, on the other side, has had a big ramp in the last couple weeks, and that is at the top of my short selling list currently because, again, people are long it for falling oil prices, really missing the point that we're still seeing the highest cost of living in American history, and 2/3 of the country are already in a recession. So again, XLY, haven't hit the button yet, but again, waiting for an overbought signal on XLY. We're getting pretty close. I think probably 0.5% away.
Okay, and then hitting on oil, can deflating oil prices trigger a sell-off in the S&P?
Of course, it already did. People go back to October, review the tapes. What I love about this game is that people have such a short memory and really are so damn lazy that they won't go back and rewind the tapes. I came from an athletic background. Maybe that's why I'm not so smart. But again, when I get rocked out there, like people did in October, I didn't get rocked, but some people got rocked. I mean, when I get rocked, I go back and rewind the damn tape. Rewind the tape. Go back to what was actually happening in October. You will see that falling global growth expectations as defined by bond yields, falling oil prices, you eventually started to matter to the whole darn thing. And I don't submit that this time is different. If you think that you can never short the S&P 500 again, that's an interesting bull case. But again, I don't think that it's going to happen this way. I think it's going to look a lot like October did.
Okay.
Because it's already happening.
Right. So this is a good one here. With so many funds lagging and looking to make up the distance on the benchmark into year end.
The bench.
Yeah.
The bench.
What's the risk embedded there, and like how do things end up falling apart?
Okay, performance chasing. What's the risk? Okay, let's maybe I've exhausted all analogies at this point, but again, think of it in hockey terms because Ben and I both played hockey and we have the flow to show for it. So again, if you look at it, let's say you're down 5-0, third period. Okay, you suck. You're down 5-0. You're like, oh my God, I got to score at least one. Like I'm gonna get fired if I can't show that I can score a damn goal. I got to score at least one. So you pull the goalie. Okay. Boom! You get scored again, 6-0. You keep pulling the goalie. Oh, 6-1, 8-1, 8-2. Oh, that was a win, right? Right? No, it's not a win. When you chase performance in the kind of way that people chase market performance, it's exactly like that. You've already completely screwed it up, and the only thing that you can do is screw it up more.
All right, semiconductors. Do you have
That wasn't very nice, by the way. I didn't mean it to sound that way. That's, if you didn't screw it up, you're awesome. Okay, how nice is that?
All right, thanks. Semiconductors. Do you have a view on the sector at all? We haven't.
Well, I mean, the rally in semis has been fantastic. Just let me pull this up for a second. Semis actually looks a lot like consumer discretionary. In fact, if I overlay XLY, which is consumer discretionary, and SMH, which is the ETF for semis, the market vectors semiconductor ETF, they're literally the same chart. They look like this, like that. They look like a V bottom, okay? So what you'll notice on both semis and consumer discretionary is that all the volume came right at the bottom of the V. So people sold the low, and then the volume has been decelerating on the upside of the V. So in other words, they've had to cover their shorts the whole way up and feel the pain. There is nothing more of a screw up in hockey, football, trading, etc. than doing that. Shorting low and covering high like people are doing in semis and consumer discretionary, not a big fan of that. Immediate term downside in the SMH to call it 51 and change. It's currently trading at 54.
Okay, great. Question here about, I guess it's probably a good answer from a duration perspective and how we look at things in different durations. But do you expect the next correction to kick off a series of lower highs and lower lows? If not, why not just position to buy the dip instead of being bearish?
Well, being bearish on what? I mean, being bullish on bonds is a much better trade because you don't have A, the volatility, and B, you have a higher absolute return. So again, I don't think in the box that a lot of people are in. I mean, if you really have to get up every morning like Joe Kernan and talk about the Dow, then I feel bad for you. But if you're really again, ostensibly you're listening to this call because you're trying to evolve and doing risk like global macro market risk moves on a global macro basis. So global macro means at a bare minimum you're looking at stocks versus bonds, and at a maximum means that you're looking at things like commodities and spread risks, et cetera. There's a lot of trades to put on. So again, we think that growth both locally and globally will continue to slow in the fourth quarter. The way that we express that is being long bonds. So you can be long bonds and you can be short the Russell 2000, and the P&L in that, forget about performance chasing. You're so far ahead of people. If that's all you had on for the year to date, you could go start a massive fund on that performance. So again, that's what I would be doing more of. On what the market's going to start to do if it starts, in fact, the equity market starts to go down, I think it could go down like faster than I don't know. I mean, think of it in Ziploc bag terms. I mean, this thing currently feels like 1,000 pounds of nasty stuff in a 1-pound bag. So when it breaks, it's going to be all over the place.
Okay, we got one more.
At least he smiles when I tell these bad jokes.
All right, we got to ask one more here. What do you think of margin levels? Why didn't the CME increase margin on SPOOs during the October volatility spike?
Well, that's a great question. I mean, I don't know. I don't know why a lot of the old wall does what they do. But if you think about the impact of that, I think that what you're currently looking at, and we have a chart that shows margin debt as a percentage of total cap, and that's right at one level it's only seen twice before. It was at this level. Margin debt, correct me if I'm wrong, was at the same level in October of 2000. October 2007 and in April of 2000. Both of those periods, you can go back and buy the SPOOs on those periods and hold them for a couple years and let me know how that felt. So again, margin debt is peaking as a percentage of cap. And that is a clean-cut sell signal from a contrarian perspective, unless, again, which the bull case is going to be, well, it's different this time. It's always different this time. This is what the bull case has always been. I just don't think it's different this time.
Yep, great. Thanks, everyone. Thanks for tuning in. Happy Thanksgiving, and we'll see you back here on Friday.